So if you're interested in funding a whole life insurance policy with a large lump sum right out of the gates, what company and product is best? Which one should you choose? Because if you have a large lump sum, and what that means is you're starting with a large dollar amount, call it $200,000, you've got that in cash that you want to move into a policy, and then after that, you're not going to hit $200,000 a year. You might want to continue to fund the policy, but you say, hey, the most I'm going to fund is 10 grand or 20 grand per year. Maybe a couple years it'll be higher, but this lump sum came from a real estate sale, an inheritance, wherever it came from. I've got the money here. I want to get it in quickly, and then after that, pay a small dollar amount. So there are some companies that have rules that will permit a large lump sum where you can carry a very, very low base premium and just get a massive amount into PUAs in the first year. You're going to exceed 10 times the base premium in year one with these companies and products. However, it's first important to know what companies allow that. And then second, it's important to see the different options because some will look better than others, and it's definitely something we want to have awareness about before starting a company and product. And this is based on someone we are working with right now who is looking at different options, and he had questions about funding his policy with a lump sum. So we've got someone who is 41 years old, has a lump sum of just under $200,000. After he funds that $195,000 in the first year, what he would like to do is fund his policy with $18,000 per year. Beginning the second year, we're going to fund the policy for 20 years in this example, as that will take him a little bit beyond the age of 60, nearing retirement age. However, he can fund longer or for a shorter period of time if he would like to. So the question is, what company and product should I choose? The first question I would ask if I'm him is, well, what companies work well if I have a large lump sum? And we're going to look at two examples here. Both of these companies will accommodate what he's looking for, which is specifically this. I want to start in year one with 195 and then fund 18K per year. You can't do that with a lot of companies. You can't get the base premium that low that will exceed the rules that they have in place, their base premium and PUA ratios. Here are two companies that permit it. We've got a smaller company in Lafayette Life, and then we have one of the four major mutual companies in Guardian. And you could not always do this with Guardian. A couple of years back, their rules did not permit it. Beginning 2022, late 2021, they made some updates with their products and they allow it now. So what I want to talk about first is PUA flexibility. So both of these companies have similar PUA flexibility. Let's forget about the lump sum. Let's pretend he starts the policy with that 195. Beginning year two, he's funding how much? $18,000 per year. That's what he's paying into the policy. Okay. The base premium on both policies you're going to see is very, very low. One example, it's $3,900. The other, it's just under $6,000. So with the $18,000 target amount, if this is you, that's how much you want to pay, he's committed to call it $6,000 per year. What he can do with both companies is commit just to the minimum premium, which you'll see that exact number, and then add PUAs at discretion. Both companies allow you to throw money into the PUA rider 100% at your discretion. They are both very, very flexible, which is nice. The different products we're going to look at. With Lafayette, we'll look at their Contender Life. And then for Guardian, we'll look at their L95 product, but we're going to look at one option that gives more cash value long-term, and then the other that gives more cash value upfront. It's the different PUA fee that's available. You'll see the two options as we go through it, but it's the same product, just with a different PUA rider that we're using. So let's go through some details here as far as the policy breakdown. First, we've got Lafayette, and this is me juicing the cash value with both products as much as I could, because this is his goal. He wants to maximize cash value. So with Lafayette, we were able to get the base premium down to $5,850. The term rider is a little bit less than $2,800. So the yearly minimum there is $8,650. If you want to round up, you can make it $9,000 per year, where the excess amount would go into PUAs. So what that means literally is he can commit to that, we'll call it $9,000, and then add additional funds into PUAs at his discretion. What it also means is in year one, he funds $195, $86.50 of that goes toward the base premium and also the term insurance rider, where the rest is plowed into PUAs. Beginning the second year, $86.50 is dedicated toward the premium and the term insurance rider, where everything else is plowed into PUAs. Call it 9 or 10 grand per year. Then we've got Guardian. What we were able to do with this design is set the base premium at $3,900. The term rider, there's two of them actually, which comes out to a total of about $1,300. It's a little bit less than that in the first year, but we rounded that up. There are renewable term riders there, so they gradually increase, but they never get that high because we dropped the term rider after year 7. One of the term riders, that is. But then we've got a yearly minimum of about $5,200. So a little bit lower minimum there. With this, he could commit to $5,200, add the rest at discretion, similar to Lafayette Life. In the first year, $195 goes in. Of that, $5,200 went toward the base premium and term insurance rider. The rest is plowed into PUAs. The same is true beginning year 2. See the differences there? Okay. PUA limits. So some of the rules of the game here that is valuable information. This, if I'm you looking at a policy, this will help me know that the policy is set up in my best interest and no information is being hidden or not being disclosed to me, which happens way too much in this business. So here we go. On the left, we've got PUA limits, $500,000. Lafayette Life's PUA limits allow for a maximum annual PUA payment of $500,000 per year. Anything higher than that does require the home office to review it. They also have term insurance rider limits. So when you take those term rider limits into account, the lowest base premium we're typically able to achieve is somewhere between 3 and 5%. So this would be referred to as, call it a 595 split or a 395 split. A good way to demonstrate that, if we use a round number, let's say you're funding a total of $100,000 per year, and your base premium we're able to get as low as 3%, and then 97% toward PUAs. That would mean your base is $3,000. You'll have a term insurance rider too, so maybe when you add the two together, it's $4,000 or something like that, and the rest is dedicated toward PUAs. But when you see that 3 to 5% base, I'm referring to the base premium there. So with their PUA limits, that's generally about as low as we can get the base premium, but then we have this 7-year average rule. So how this works is Lafayette Life will look at how much you've paid in PUAs during the first 7 years. And then they will take the average amount that was paid into PUAs over that 7-year period, and that is then your new maximum that you can pay into PUAs beginning year 8. Make sense? Let's go through a quick demo there. We can use this example. We'll use round numbers. So PUA payments, in the first year, if his yearly minimum, the base premium and term rider, let's say it's just $8,000 for the sake of simplicity. So if he's got an $8K minimum premium here, how much went into PUAs of that $195? That would be $187. So the first year, $187,000 toward PUAs. The rest went toward the premium. The second through 7th year, which is a total of how many years? 6. How much went to PUAs? Well, if he's paying an $8,000 minimum premium and a total of $18,000, that means $10,000 per year went toward PUAs. These are his PUA payments down here. So what you would do is add these up and divide by 7. So here you've got 60K. Above you've got 187. So let's add those together and then divide by 7 here, shall we? 187 plus 60, 247. Divide by 7, $35,000 in change per year. So what that means is if he wanted to add more than $18,000 beginning year 8, he could. The maximum amount he could pay in this example, beginning the 8th year, would be about $35,000. And that's on top of the yearly minimum premium. That's how Lafayette Life calculates their PUA rider and specifically the maximums with after the first 7 years. Hope that made sense. If not, I'd rewind and watch again. Now, Guardian is a little bit more straightforward. So with Guardian, in the first year, they will allow 50x the base premium to be added into PUAs. That allows a 2% base premium in the first year. And then the most we can illustrate in the software beginning the second year is 10x the base premium. And this assumes we have a 1-year term insurance rider attached. If you do not have that attached, you can only illustrate 3x the base premium in PUAs. So that 1-year term insurance rider is critical, but if you do things right, that'll give you the strongest guaranteed and non-guaranteed cash value. All right, let's take a look at the numbers now, shall we? This will be a lot of fun. Here we go. First year, $195,000 added or deposited. Your first year cash value, $184,000. What is highlighted in yellow is the break-even point. So it's year 4 in this example. That lump sum really accelerated the cash value growth. What you could likely do in this example to improve the performance even a little bit more, I would actually spread that lump sum out over the first and second year. Now, of course, it depends how he wants to use it and such. If someone really wants to get the money in and the difference is not that drastic, they still might add it in year 1. But sometimes spreading it out does make more sense. Depends how much I'm funding after the lump sum. But in this example, the target is to get a lump sum in right out of the gates, and this is strong. There's your break even at year 4. With Guardian, we're going to look at their L95 product. First, their 5% PUA fee, which is a lower PUA fee, and here you go. So the first year cash value is almost the same. There's not much difference there. What is it, $900 when you're paying $195? Like, there's not much of a difference there. The death benefit's much higher. And the reason why is because this product does have a higher guaranteed rate. It's 3% compared to this guy. It's 2%. And why that's important to be aware of, if you like the details and you're trying to understand why the death benefits are different here, is the higher the guaranteed rate, what that means is that I need a higher death benefit to get the same MEC limit. So the MEC limit in these examples are both right around $200,000, a little bit above the 195. Over here, I have a lower guarantee, which means I need less life insurance to attain the same $200,000 MEC limit. If I run a Guardian product with a 2% guaranteed rate, I would see a death benefit similar to what I've got here. Hope that made sense. Let's continue on. So with this guy, cash rich right out of the gates. First year, you're about the same, but look at year 2. You've got about $5,000 more in cash value, about $7,000 more in cash value by year 3. That's your break-even point. This is great for strong upfront cash values. This will also have the strongest guaranteed values when we compare the different options. So this is a popular option with a lot of people we work with that like strong upfront cash value and like strong guaranteed cash value. So for someone who's very conservative, this is a fantastic option. Then we've got the same product, but with the 10% PUA fee. So with this guy, we've got more money going toward PUA fees, which is going to hurt the upfront cash value the most. Where you're at 175 right out of the gates compared to the other two, it's about a $10,000 hit. That's more than I'm going to blink at. That's $10,000. Now, as time passes, you do make up for it. Break even, very close to the Lafayette Life example. There's about $1,000 or $1,500 difference there. By year 4, year 5, you're positive. You'll notice long term, this one does look the most attractive here, based on the non-guarantees, not the guarantees. So we're going to look at a comparison. We'll also look at a breakdown of the premium and PUA. We will look at the compensation as well. That question does come up. Hey, what are the commissions paid on both of these? Sometimes people ask. Before I pull those up, which option would you choose looking at these? Or which two are you leaning toward? If you still want to compare both companies, which Guardian one would you prefer? Let's start there. 5%, or the 10%. If you are thinking I need to see the guarantees, we would show you that. But based on this, which one would you prefer? It does depend. In this example, we're going to pretend that you select that option, the 10% PUA fee, which has weaker guarantees than this one and less cash value up front. But what we're going to do is compare it with the example on the left. This is often how we help one refine their decision-making process. By the way, we do go through the detailed illustrations in a case like this as well, or all cases actually. So here's a comparison based on the current dividend rates. This is assuming dividends are being paid. These are the two examples we just looked at. The only difference is this column here, CV, which stands for cash value, baby. We've got the difference. So what this is showing is with the Guardian policy, how much more or less you have in cash value with this option compared to this option. Remember, this is the 10% PUA fee, which had less upfront in the first year. There's your difference. Now you get very close there in year 4 and 5 when you look at it. In year 6 to 7, it's right around the same, $1,000. Then when we drop one of those term riders, start to pick up the pace. And we can scroll down, but what you will see happen is the values will get stronger and stronger for the Guardian product when we compare these two. Now, that is based on the non-guarantees. So what we can also look at here are the guarantees or no dividends. So these illustrations are assuming no dividends are applied at any point in time. And what do you see here? Bit of a difference, isn't there? Stronger with the Guardian option. And a big reason why is because of that higher guaranteed cash value interest rate with this product. What you'll find with Guardian, Mass Mutual is similar with this, is they have a lot of products with different guaranteed rates, some that are strong on the guaranteed and non-guaranteed side of the illustration. Lafayette, most of their products, have a 2% guaranteed rate. And why that's important to mention is what you'll see in a whole life insurance policy is that the lower the guaranteed rate is, 2% is as low as a company can go in a whole life insurance product. The lower the guaranteed rate is, the higher the non-guaranteed values are. So when we look at a product with a lower guaranteed rate, where the numbers will look the best are on the non-guaranteed side of the illustration. If we wanted stronger non-guaranteed values with a Guardian product, we would look at a product that has a 2% guaranteed rate, like one of their 10-pay policies. But again, what we've got here is the L95 with a 3% guarantee. But we see stronger guaranteed and non-guaranteed values. So let's take a look at a breakdown here. And what we're going to look at is what we had up here earlier, the breakdowns. And looking at each illustration, we've got the illustrations exported to Excel here. Again, if you're working with us, you would have received these illustrations even before we go over the numbers or when we go over the numbers, the actual illustrations from the insurance company. So on the left, we've got a clean breakdown as to where the money is going. There's your base premium. There's your PUA rider. I will say this actually, the term rider is actually included in the PUA here. I didn't include that column just because there's getting to be a lot of columns, but general breakdown of where the money is going. Total annual outlay, what he wants to do, $195 in the first year, then $18K per year thereafter. So looking at this, what do you have here? Total outlay, cash value, death benefit. Break even is at year 4 in this example. Now, here's a question that comes up. What is the compensation with these two different companies? So on the left, we've got the total annual comp. This is based on the rate we would receive. Lafayette does pay a much higher rate, and you'll see this with a lot of smaller companies, not all small companies. It has to do if the company issues business in the state of New York or not, but long story short, the compensation is high, both on the base premium and PUA. But we've got the total annual amount, first year commission, and then renewals, and then also the running total, which just tallies everything up. So with this example, first year commission would be over 17 grand. Keep that in mind when we look at the next example. So you've got the base premium, $3,900, That's where the bulk of any commission is paid on a whole life insurance product, the base premium, and the PUA rider, annual total, cash value, death benefit. Again, this is the 10% PUA fee, and there's your compensation. So what do you notice here? Bit of a difference, isn't there? What I always like to look at is what's the running total compared to the first year commission when I see a big difference in policy performance. And the guarantees are always good to look at. This is based on the non-guarantees, but the guarantees are always good to look at when we are comparing policy performance and total commissions that are paid to a product. But good information to be aware of. If people do want to see it, we can show it, as we do have a workbook that calculates exactly what the commissions would be on any product we would offer, or almost any product that we would offer. It's based on the rates that we receive from the insurance carriers. In any event, I hope that this was informative, especially if you are considering a policy with a lump sum and then funding a small amount thereafter. If you're looking at a policy just with a one-time lump sum, I would actually do things a little bit differently, or much differently than this. I would not add the full lump sum into the policy on the first year. I would spread that out anywhere between 3 to 5 years, depending on your age, product we're looking at, a couple other factors. We've got some videos, or several videos, that go into detail on that. But if you've got a large lump sum up front and you plan on funding the policy with a low amount relative to the lump sum afterwards, I do hope, again, that this was valuable. Let us know your thoughts, and we will talk to you soon. Thanks again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.